Good morning, everyone. It's October 3rd, and we're going to talk about mortgage rates today. Give you a little bit of an update, let you know where they are today, where I think they're headed, and what's going on with them. Um, First, we should probably touch a bit on the Fed comments. So, when we're talking about the Fed, they're the ones that have basically all of the control when it comes to mortgage rates right now and where they go. If their comments is what's going to cause everything. So if they say that they're going to do more rate hikes, then rates are going to keep going up. And there's not really much that I think is going to stop them from keeping to increase rates at this moment. But they are even mixed inside their own ranks. So you can kind of see from this last meeting, we've got a bunch of different comments here. One of the feds is talking about they want two more rate hikes, and then but we also have these at the bottom here. We've got some that are saying they want one more rate hike or no rate hikes. So there's no urgency to So there's dissension inside the ranks essentially. No urgency to raise hikes. We've got some that are saying two, but regardless, they're going to keep raising rates, and not much we can do about it except for just weather the storm. Um, so how how do we follow the rates? How do we predict what they're going to do? The market is going to tell us everything we need to know. When we're talking about mortgage rates, the first thing you need to understand is mortgage rates are set by lenders looking at the mortgage backed securities each day, seeing where they're trading, and based on where they are trading for that day is where you'll see them set their rate sheet for their products for that day. And then they continuously monitor the mortgage backed securities throughout the day. If they increase or decrease by a specific amount that they've got set, then they're going to change their pricing even for that day. Midday pricing is typically what we would call that. Um, so if we're looking at today's interest rates, or essentially the market today, this is what we're gonna see. So if the lenders basically woke up this morning and they saw this huge drop in mortgage-backed securities, so they're setting their pricing today a bit higher than it was yesterday, and higher than it's been ever. Not ever. I shouldn't say ever, but it's a 10 or 15 year high on interest rates right now, and they're continuously getting higher. If you have been talking to me for the last couple of years, when interest rates started going up, I predicted they were going to get to about 9% before they started to flip the corner and come back down to where we would see normal interest rate pricing again. Good news is we're getting pretty close to that 9% mark. Bad news is that we're getting there starting today. Um, so where do I think they're headed, and how quick do I think they're going to get there? You know, we've just broke out of the previous channel that we were in. So if you're looking at these, like the channel of where our rebounds have been, it's been this almost super consistent line of where we've been rebounding to gain some better rates. So I watch this all day long, every day, and when I have loans in the pipeline, I try and lock them when we hit these peaks here, so that I can get the best pricing available. Doesn't always happen that way because you can't 100% predict this, but we can kind of see that we're breaking below this channel, which is going to start this new channel, and I think this is fairly this is pretty much what we're going to start seeing, is kind of this more of this last quarter channel that we've been in, as whereas pricing is trending. So I've got my new kind of safety line down here at the bottom, but I think that's kind of where this is going to trend in the coming months. We might have a couple of days where we'll kind of peak up a little bit, but I can see us kind of continuing along on this line. And just so you can kind of see, this is kind of the 2 year mark of where the trend has been, and we're well below, or anything we've seen in the last 2 years. So when I don't remember if I explained this, but as mortgage-backed securities decrease, interest rates go up. So that's just how the market works. If we want to see how they are looking today, I can kind of show you where we priced out a standard conventional and a standard FHA loan. So 5% down conventional, this is what you'd expect to see today without any points. So if you have a client that just needs the lowest amount of closing costs possible, they don't want to pay any points at all, then this is kind of where you'd see them. An 8.329, no points. And that's where we're at. But they're not charging very much to get below 8%. So half a point, it would get you 7.999. So we're not too far away from getting below 8. FHA, their normal rate looks pretty similar, 8.0, a little bit better than the 8.3 in a conventional, and it's pretty typical to see interest rates being lower on FHA than you would see on conventional. However, the mortgage insurance on FHA is going to be higher than you would see on a conventional with someone with decent credit score. So they'd pretty much even out to where the conventional, even though the actual rate's higher, the actual overall payment may be lower with someone with decent credit. With FHA though, if you're looking to maybe have a couple of points or pay a little bit of points, you can actually get pretty low with just 0.675% charged in points. In this example, that would have been $2,200. I think I put a $350,000 purchase price on this example. But yeah, so 7.25 is not too expensive to get to on an FHA loan, which is quite a bit better of increase than we were seeing on the conventional. So we only got a 0.4%, less than 0.4% on the conventional, where we're getting over 0.75% on the FHA.